Do you think the next meeting will mean rate cuts now for Turkey?
Well, to be quite honest, I mean, if you ask any analysts out there, they were so surprised about everything last week. And let's face it, it was a big surprise because the assumption was that President Erdogan had given his blessing for the 200 basis point rate hike. And that assumption was obviously wrong. So we all got it wrong, or everybody got it wrong out there. So I think looking ahead, could we have a rate cut? Yes, we could. And why? Because with the benefit of hindsight, Turkish real rates on a forward-looking basis are at about 7% now. This is one of the highest in the world. And the question is, why should it be this high if the basic balance, so the current account plus the FDI, is only around 2 to 3% of GDP? So there is that question of why it should be that high.
We saw, obviously, investors dump the lira as well as stocks, especially domestically focused banking stocks. How does Sahap Kavcioglu, how does he gain investor confidence?
Well, I think the aim now for any central bank governor is to calm down expectations, markets, and to build expectations locally, domestically. So you need to gain the confidence of the population, of the local electorate on the one hand, as to where inflation is going. And you could cut interest rates. There's no reason why you can't cut interest rates from these real rate levels. And the second thing is obviously gaining market confidence of investors, both local investors, because let's not forget it, Turkish investors, population, the electorate, are the most savvy investors out there as far as the Turkish lira is concerned. And you see these constant moves of Turkish lira deposits and FX deposits over the last 12 months.
The Turkish lira this morning, 7.9116, inching towards that 8 yet again. Simon, where do you see the lira settling after all of this?
If I had a crystal ball, I would tell you. Look, I mean, we did see a classic overshoot. The 15% that we saw yesterday morning, Monday morning, was a classic overshoot when you see a peg being released of a currency. So I think the overshoot was very, very strong, way too much. So, and that was the surprise effect, given that everybody had expected Erdogan to be on board with the 200 basis point rate hike. So I think looking ahead into the next 1 to 2 weeks, we could see it coming from here. There's no question.
I want to ask you one question about Turkey and what it means for the rest of emerging markets. Is this idiosyncratic to Turkey, or do you think we can see risks of contagion to other places in EM?
No, it's a very good point. And look, let's face it, with the Fed telling us, massaging the words, if you like, the wording of its policy over the next 6 to 12 months, and possibly even starting tapering later on in the second half of this year, indicating that it's going to taper, it's going to be very tough for central banks in emerging markets. There's no question. Emerging market central banks are always at the receiving end of this. So we've seen big rate hikes in Turkey, in Brazil. We've seen rate hikes in Russia. We're going to see this happen over the next 3 to 6 months. The big challenge in the short term are the very, very low base effects from oil prices last year. We got 200% year-on-year increase in oil prices in March, and food prices about 25% year-on-year increase. And all of this hits emerging markets disproportionately. So it's not only idiosyncratic. The idiosyncratic element is the politics. And, politics everywhere we've seen in the last 12 months isn't ideal.